The history of commodities trading in London dates back almost 1,000 years. In the Middle Ages, wines and spices were traded on quays on the banks of the River Thames. In 1570, the Royal Exchange was opened by Queen Elizabeth I as a centre for trade in the city. Although the Royal Exchange building was destroyed in the Great Fire of 1666, commodities trading survived and flourished. The traders moved to coffee houses. So their customers could find them, each trader frequented the same coffee house every day. The most notable of these was a coffee house by the name of Garraway's. The volume of trade grew as trading horizons widened with improved communications. Merchants buying whole cargoes of goods to arrive many months hence needed a means of insuring themselves against the risk of volatile price movement in a particular commodity between the time of purchase and future sale. The futures markets evolved to enable merchants to hedge their physical purchase or sales by providing a kind of price insurance, and thus avoiding running the risk of exposure to volatile price movements. In the early 19th century, trading moved to the new London commercial sale rooms. The market remained in this building for more than 100 years, until its destruction during the Second World War. The market moved, and after the Second World War became the London Commodity Exchange, or LCE. Within the LCE, commodity traders grouped themselves into terminal market associations in cocoa, coffee, raw and white sugar. In 1987, the LCE moved to new premises at St. Catherine Docks and became London Fox, the Futures and Options Exchange. Here, the cocoa, coffee and sugar markets share a floor purposely designed for trading. The importance of commodity trading to the British economy is clear. The invisible export earnings of commodity trading is substantially greater than that of the International Stock Exchange in London, for example. Thus, commodity markets are significant in terms of the UK economy. A futures contract is an agreement to buy or sell a fixed amount of a commodity at a fixed price on a fixed date in the future. Futures can be used by trade houses, producers of a commodity, and also manufacturers who use that commodity to lock into a price today for some time in the future. Each of these users has an important part to play in ensuring the smooth operation of business conducted on the futures markets. The producers from the origin of a commodity will sell their physical product either direct to the manufacturer or through an intermediary in the shape of a dealer. The producer may take out a futures contract through an authorized floor member or AFM to hedge the risk of price movement. The manufacturer may buy direct from the producer or through the dealer. The manufacturer may also take out a futures contract through an authorized floor member to hedge the risk of price movement. The dealer may act as the broker between producers and manufacturers, buying from the producer and reselling to the manufacturer. The dealer may take out a futures contract to hedge the risk of price movement incurred by his physical transactions. Producers, manufacturers and dealers will all use the futures markets as a means of pricing the physical contract. The investor will take advantage of any opportunity to make a profit by calculating the risk-reward ratio in taking a position on a particular market. His activities are purely speculative and are not intended to hedge a physical position. Each of these elements is essential in providing a liquid futures market. That is to say, one is able to buy or sell with relative ease. It may appear at first that using a futures market increases the price risk to which a buyer is exposed. After all, buying in the physical market alone is a normal purchasing activity which does not seem to carry unusual risk. However, it is clear that by not hedging a raw material, a buyer may be taking unnecessary risk and foregoing the opportunity to insure his purchases against adverse price movements. It is by no means essential for a user of a physical commodity to use the futures markets, However, they can be a useful tool in achieving adequate and effective supply at lowest cost. Here's an example of how the futures markets can benefit the manufacturer. The coffee manufacturer had reckoned to spend about £1,500 a tonne on coffee this year, and he has based his annual budget on this assumption. But because of an unexpected frost and shipping difficulties, he now believes that coffee could rise above that price to £1,800 a tonne. In November, he expects he will have used up his supply of low-priced coffee by January, and he will be forced to buy coffee at a new, higher price to keep his factory going. But obviously, the coffee manufacturer doesn't want to spend £1,800 a tonne on coffee if he can help it. So, still in November, he buys January futures contracts for coffee at £1,500 a tonne. Buying a contract is known as being long of the market. 3 months later in January, the price of coffee beans has gone up, but even more than anticipated, to £2,000 a tonne. Nonetheless, he has to buy his physical supplies of coffee at £2,000 a tonne, £500 more than he had originally calculated. But at the same time, he sells those futures contracts bought in November for £1,500 a tonne, which have moved up in line with the physical market to £2,000 a tonne. On the one hand, therefore, he makes a £500 profit a tonne on his futures contracts, which balances out the loss he's making on the physical market, making the net cost of his coffee beans £1,500 a tonne, just as he had originally calculated. The futures markets can work in exactly the same way to the benefit of commodity producers. Here's an example of how the producer can use the coffee futures market. Just as the manufacturer fears the price of coffee going up, the producer fears that the price of coffee might come down, thus eroding his profit margin. The coffee producer had hoped to get £2,000 a tonne for his coffee that year. But in January, it is already clear that he is in for a bumper harvest, and news from other producing countries suggests the same. Prices are bound to fall. He won't be ready to harvest his crop until March, when he fears the price of coffee may drop as low as £1,700 a tonne. So still in January, he sells March futures contracts for coffee at £2,000 a tonne. This is known as being short of the market. 2 months later in March, the price of coffee has fallen, but even more than he had anticipated, to £1,500 a tonne. Nonetheless, he has to now sell his physical supplies of coffee at £1,500 a tonne, £500 a tonne less than he'd hoped for. But at the same time, he buys back those March futures contracts, which he sold in January for £2,000 a tonne, which have moved down in price in line with the physical market to £1,500 a tonne. On the one hand, therefore, he makes a £500 profit on his futures contracts, which balances out the loss he is making on the physical market, leaving the net revenue from his coffee crop £2,000 a tonne, just as he had originally expected. In both these examples, futures are being used to lock into future prices. This technique is known as hedging. Whether the futures user is a buyer or a seller, the futures contracts themselves are bought through an authorized floor member of a market. What follows is an example of how such a transaction takes place. A trade house buys a parcel of coffee for shipment in May. In order to balance its risk, the trade house will sell an equal quantity of futures contracts for July as a form of price insurance. Since the quantity which the trade house needs to cover is 500 tons, and the contract size in coffee is 5 tons, the trade house therefore needs to sell 100 futures contracts in order to hedge its risk. Once the contract with the producing country has been agreed for the physical purchase at a given price for a given quantity on a given shipment period, the dealer will call his trader on the floor of the exchange to find the price of the position he wishes to have hedged. The trader gets a price through a system known as open outcry from other traders on the floor.
How would you like 9?
He will then inform his office of the price at which he can fill the order. The dealer will then give the floor trader the order to go ahead and execute at a given price or better. The trader will then do so. Once the deal has taken place, both the buyer and the seller fill in trading slips in order to record the details of the trade which has just taken place. The information contained on them is then input from the rostrum on the trading floor into the clearinghouse computer matching system. The system processes these slips, matching sellers with buyers. The information is then transmitted through the real-time computer system of the International Commodities Clearinghouse to both floor members' back offices, where the parties involved must then claim the transactions in which they have been involved. Should the slips not match for some reason, for example, the quantities are incorrect, the differences are highlighted via an inquiry screen situated on the market floor. It is then the responsibility of the traders concerned to correct the mismatch as soon after it is highlighted as possible. Not all futures users are interested in hedging. Some futures users are investors who seek to profit by speculating on changes in futures prices, but who have no interest in the underlying commodity. They certainly do not envisage taking delivery of 50 tons of cocoa sometime in the future. These investors may be individuals who seek the advice of a broker who provides a service to private customers, or indeed they may be participants in a collective investment scheme or fund, the manager of which may be acting on their behalf. The investor, although not involved in the production or consumption of the commodity itself, can nevertheless be a valuable contributor to the futures market. He can provide additional liquidity to the market, which makes it easier for the traders to transact their business. In addition, he is often prepared to accept those very risks that the trade user of the market is trying to avoid by carrying out his hedging activities. Here is how an investor might use futures. An investor believes that the price of sugar is likely to rise. He therefore contacts a futures broker and gives an order to buy sugar futures contracts. The trade is executed in the normal manner. The futures broker will then hold the position for the investor. At a given moment, the investor will instruct the futures broker to sell the position. If the market has risen, he will have made a profit. If the market has fallen, he will make a loss. In order to work reliably and effectively, each futures market is carefully designed. There are three sorts of members of the exchange: authorized floor members, traded options members, and local members. Only these three categories of members are permitted to trade on the floor. Additionally, there are associate members who are affiliated with the exchange because of their trade interests, but who have no trading rights. Authorized floor members who buy membership of the market in which they wish to trade are entitled to place floor traders on the market once they have been trained and sat an examination run by the exchange. Locals trade on their own account and also for other authorized floor members.
59.
The traders on the floor are regulated by the market manager or call chairman, who supervises the trading and is responsible for making sure that all paperwork relating to a trade matches. On the cocoa and sugar markets, the call chairman starts each trading session by inviting bids and offers in each delivery month. On the coffee market, each month is opened by a buzzer signifying that trading can take place. In the center of the ring sit the rostrum clerks who deal with price and trade reporting. They operate one of the most advanced commodity price reporting systems in the world, which gives floor traders an instantaneous video price update, and is also available worldwide to any interested user of the market through a number of news vendors, which includes AP Dow Jones, Knight Ridder, Telerate, Reuters, and Unicom. This ensures that the prices reported on all London Fox markets are available as they are traded. This is known as price transparency. The price reporting system provides information about the last bid and offer in each month, the last trade done in each month, and the time it was executed, the high and low for the day, and the number of lots traded. The exchange relies on the support of the International Commodities Clearinghouse, or ICCH, which is a vital element in guaranteeing the financial integrity of the London futures markets. All futures markets need a clearinghouse. This is the organization responsible for recording details of all the contracts traded on the markets and ensuring that the obligations entered into by the members are fulfilled. The ICCH guarantee is given subject to the regulations of each market and is based on the daily calling of cash or acceptable security equal to a member's liability for deposits and margins. Once a deal has been matched at London Fox, the information is fed into the ICCH real-time computer system online to all members. The parties involved in a deal must then confirm the deal and allocate the trade to either house or client account. After confirmation and allocation, the ICCH becomes the counterparty to every trade, which means that it becomes the buyer to every seller and the seller to every buyer. By providing this substitution of counterparties, the clearinghouse eliminates risks for a user of the Fox markets. In order to provide this protection, the ICCH clearly requires substantial financial reserves. The ICCH is largely owned by Britain's high street or clearing banks, which between them provide a discrete tangible backing of £150 million. Each of the cocoa, coffee and sugar markets has a floor committee. This is responsible for good behaviour on the floor, for adjudicating disputes during open trading, and serves as a link between the floor and the management committee. Above this is the Futures Market Committee, or FMC, for each market. The people who serve on the FMC are elected by the members of the market. The FMC sets the rules and regulations of its market. A representative of each FMC sits on the main board of London Fox. The board acts as the voice of the commodities futures market to the City, the Bank of England, the government, and to overseas trading associations. It serves to promote the market's competitive success and protect them from any disruptions which may threaten their ability to compete successfully with other commodity markets. There are 3 trading rings on the floor of the London Fox building at St. Catherine Docks, each of which trades a specific commodity. On the cocoa market, the contract size is 10 tons. The contract is quoted in pounds sterling. Delivery dates are available for March, May, July, September and December. 7 tradable months are always quoted, which allows for trade up to 15 months in the future. The cocoa market operates from 10 a.m. in the morning to 1 p.m. and then from 2:30 p.m. to 4:45 p.m. in the afternoon. On the raw sugar market, the contract size is 50 tons. The price is quoted in US dollars and cents. Delivery dates are available for March, May, August, October and December. Again, 7 months are always quoted to allow for trade up to 15 months in the future. The sugar futures market opens at 10:30 a.m. in the morning and closes at 12:30 p.m., but reopens at 2:30 p.m. and trades until 7 p.m. in the evening. The coffee market has a contract size of 5 tons. Its price is quoted in pounds sterling. Contracts are available for January, March, May, July, September, and going 13 months forward. The coffee market trades from 9:45 a.m. until 12:30 and reopens at 2:30 p.m. and continues to trade until 5 p.m. The exchange also offers traded options contracts on each of its underlying futures markets. There are now commodity exchanges all over the world. But London Fox is unique in having a number of distinct advantages which none of the other exchanges share. The first is London's geographical location, which straddles the world's time zones between the East and the West. This means that a trader in London can deal with the Far East in the morning and North and South America in the afternoon. The City of London itself provides a network of banking, insurance and shipping services which aid the professionalism of the markets. The ICCH guarantee provides considerable benefit to Fox members, who are completely protected against default on the part of the original counterparty to the trade. What this means is that even if the party with whom the original trade took place goes out of business, the other party involved in the original deal is covered, since the deal is now not with the original trader, but with the clearinghouse. The commodity contracts traded in London are compatible with what the market requires. This is because they were designed by the practitioners who are going to use them. All of the London Fox commodity contracts are designed to fulfill international criteria laid down in the rules of various physical associations, and also in accordance with European community regulations. All the contracts traded on London Fox have the capacity for physical delivery with strict standards of quality, closely monitored by the exchange. The exchange grades cocoa and coffee. Every lot has a physical sample which is checked to ensure that it is up to standard for delivery. Moreover, all parcels of cocoa and coffee beans delivered against futures contracts must be to London Fox approved warehouses in the port of delivery. Sugar deliveries are made basis-free on board at the port of origin, again with quality standards strictly adhered to. All users of London Fox can take comfort from the fact that the London futures markets are well regulated by an Act of Parliament, which lays down minimum standards as well as insisting that brokers should be adequately capitalized for the business they transact on behalf of their customers. London Fox is authorized to operate as a recognized investment exchange under the Financial Services Act of 1986. All floor members of London Fox have to be authorized members of the Association of Futures Brokers and Dealers, the AFBD, which exists to provide protection to all users of the markets. Another notable feature of London Fox is that it was the first exchange in Europe to set up a viable automated trading system, or ATS. The system was developed in conjunction with the ICCH. The current white sugar market trades via this system. The system automatically matches bids and offers, not by open outcry on a trading floor, but on a computer screen. The system is operated from members' offices linked into a central processing unit based at the ICCH. A trader will input a bid or offer via the trading screen. When an order is entered and a trade takes place, the system will time log and print out details of the transaction. This allows a complete audit trail, recording the details of each deal. The ATS is an alternative method of trading futures contracts. The existence of the system allows London Fox to develop new contracts which would otherwise be prohibited by the cost of setting up an open outcry floor. London Fox, therefore, combines traditional open outcry markets with the advanced technology of an automated trading system, showing that it can adapt technology to assist and develop trading by traditional methods, and providing all users of the markets with a first-class professional hedging and speculative medium.